It's June. How did that happen? Friday, June 3. First Friday every month we get news of U.S. employment in the immediately prior month. The whole financial world, all over the world, hangs on the data because it's fresh data. It's from the immediately prior month, and it's about jobs, which is a proxy for the economy, and it's also in wages a proxy for what may be happening with inflation. And this morning at 6:30 in the morning Colorado time, nobody believed what scrolled across the screen. Instead of the forecast 170,000 jobs, we have 38,000. Both of those forecasts had assumed that a Verizon strike had trimmed the numbers by about 37,000 jobs. But we went from, it's one of the biggest forecasting errors in the last 15 years. The payroll data, for all of its importance, is the most heavily revised report that we get. So by a month from now, the Bureau of Labor Statistics may say, oops, we missed California. There are other pieces of the report. It's a very comprehensive affair. It includes wages, which didn't move much. There's no acceleration in wages that would lead to inflation. The unemployment rate fell to 4.7%, which under normal circumstances would tell the Fed that the economy is very badly overheating, the Fed's behind, the Fed should tighten tomorrow. With an unemployment rate that low, wages are bound to go up. The term new normal has kicked around for at least a dozen years, ever since the first recession that was known as a jobless recovery in the early 2000s. That was 2001, 2, 3, 4. And we've been at this long enough to know that nobody has any idea what normal is. The Fed says that it's normalizing its interest rates, but what's normal? Relative to what normal economy? So buried in the payroll report, not only is no sign of inflation, but very strange numbers. At least in theory, 500,000 people last month stopped looking for work. If you stop looking for work, you're no longer unemployed. So the unemployment rate went down, but didn't have anything to do with anybody getting hired. There's another category in the unemployment stats known as U6, which includes not only the unemployed, but includes those who have taken jobs that are part-time, but who wanted full-time jobs. And in theory, U6 went up by 500,000 people in May. No. But boil all this stuff down and boil down the collateral reports, and the U.S. economy isn't accelerating. We've got housing doing well, we've got oil up a little bit, the job market is pretty good, and those are all good reasons for the Fed to raise its interest rate even at its June meeting in a couple of weeks. This job data knocks the Fed out of the game probably for the summer, unless there's a very strong rebound and a correction in these job numbers. But the real story, as I hammer away at every Friday, is outside the United States. The copy nearby goes through Europe's latest issues, Japan's latest issues. The rest of the world is in a lot of trouble. And U.S. mortgages and bond yields began to go down even before this job report. Our rates were trickling down yesterday morning before the report, which itself is very unusual. The report is so variable that it can kill you if you take any position at all. The yield on German 10-year bonds, Bunds, fell to a new all-time low, just above zero. And Japan's 10 years are below zero. And so a U.S. 10-year paying 180, yesterday looked fat, now it's 170. Mortgages are 3.625. We are now in at least the sixth visit near the 2012 all-time low. And Fed or no Fed, U.S. recovery or no recovery, the Fed at an emergency level that it really should come up from, if anything, rates are poised to go lower. Have a good weekend.